Hello, I'm Stephen Galpin and this is Property Question Time, the show where you can have all of your property related questions answered by our team of experts. And joining me today is Saul Conway, MD at AS Financial Mortgage Advisory Services. Welcome to you.
Thank you.
And Steve Eakins, Key Partner Director at Lumon, Overseas Currency Experts. Welcome to you too.
Thank you for having me.
Now, both your first time on Property Question Time, so we'll try and go easy and make it a pleasant experience for you. Looking forward to hearing what you've got to say to the questions. So, okay, so I'm going to start with you. I'm considering buying a flat on a shared ownership basis. I will obviously need a mortgage to buy the initial first half of the property. Looking to the future, how can I be sure that I can get funding to buy the other half as and when my finances allow it? Does the mortgage company I use for the purchase of the first half have any obligation to assist me on the purchase of the whole? Now, I just wonder whether, before we start answering that particular question, whether you want to just give a quick overview of what shared ownership is for some of our unenlightened viewers.
Okay, so shared ownership is a type of purchase where you can purchase just a percentage of a property. The advantage being is if you're unable to afford the whole property, you're able to buy some of the property. The disadvantage is you pay rent on the remaining bit that you haven't purchased, but at least it gets you into a home maybe in the area you wish to be in without necessarily being able to afford to buy the whole thing.
Okay, so there is an incentive then to buy the other half.
Absolutely, because you want to own the whole home, and also normally your mortgage payment will be lower than the rent you're paying for that share.
Okay. Now, I'm just looking at the tone of the question here. Is it a normal building society or bank lender that usually finances these, or is it a specialist? As you get a buy-to-let lender, is there a sort of shared ownership lender?
We're actually rather lucky at the moment that almost all the high street lenders participate in this market. So you do have a really wide choice of lenders. It's become a very normal scheme, supported by the government, supported by local housing authorities. So therefore the providers are very, very comfortable in lending on this type of scheme.
Okay. Well, look, a little bit like I sometimes have worries about buying off plan, because in essence you've got to guess what your finances are going to be at the time that building is completed. And I'm just wondering here how you sort of work out where you're going to be at the point that you do want to buy the other half, and as the questioner asked, is that first lender obliged to help you?
Absolutely. So unfortunately, there are no guarantees. Okay, the lender that initially lends you the money,
in life, isn't it?
Absolutely, especially with mortgages. So the lender that lends you that initial amount is under no obligation to ever lend you further money, or even when your rate comes up, because normally people pick a 2 or 3 or 5 year rate, to even give you further lending after that. So there is a little bit of guesswork there. But you are entitled to stay renting that other share and stay with the percentage you have for as long as the lifetime of the property, until you sell. So it's not an absolute must that you have to go what's called staircasing. As you purchase more percentages of the share, they can still call that staircasing. There's no necessity to do it, but it can be beneficial. Most people hope, depending on who they are, that their income over time will grow. And that extra income that they have will allow them to purchase more of the property. But unfortunately, there are no guarantees. And obviously, if your income either doesn't grow or goes the other way, you have some problems with your income, you're never going to be able to purchase more of the property.
Now, look, I know it's always dangerous to look at stats, but I did see some stats a few weeks ago that suggested that handing back of keys was far more prevalent in that type of purchase, in a split ownership purchase. Have you found that, or?
Where we find issues around these sort of purchases is because there's individuals buying homes that technically they can't afford, and then they've got rent over and above their mortgage. The property price often relates to the service charge or the upkeep you need to put into it, or these are normally new builds, which take a little bit more upkeep over the 3 to 5 year period to keep them looking as good. And people don't quite associate those extra costs with initially when they purchase, and they're costs that maybe they shouldn't be having because they're buying a property they can't really afford. And that creates issues down the line for some people.
Just an interesting point. I mean, these blocks with shared ownership, I mean, presumably there's a service charge.
Yeah.
Where does the liability for service charge fall? 50-50 or
It doesn't,
always
no,
on
it's
you?
100% on the purchaser, unfortunately. And that's exactly one of the issues. And people don't realise that. And let's say these blocks, often high-rise, will have a lift, very expensive to run. So you could be sometimes into thousands of pounds of service charges when you could only really afford a mortgage of maybe £70,000. So your mortgage a month may be equal to the service charge a month. And so your cost can really be high.
Yeah. Okay, great stuff. Steve, have you got anything to add to that?
Nothing from me, no.
Okay, I know that's not your subject, so we'll forgive you that one. Okay, but what we will do is move on to your question, and it's this. Are foreign exchange companies regulated in any way, specifically in relation to the exchange rates that they offer? Or is it simply a matter of shopping around? Now, I know that's a big subject, but...
A really complicated topic, but equally a really popular question that everyone asks, because obviously they're very keen to make sure that they're dealing with the right people who are regulated or authorised in the right way. Another considering factor is also following Brexit. If someone's using an international payments firm and they're looking at relocating abroad, that they can actually provide that service on the continent as well, for example. So from our perspective here, we're regulated and authorised by the Financial Conduct Authority as an e-money institution, but we're also authorised by the Bank of Ireland, allowing us to service clients who are registered and located across Europe.
Okay.
With regards to what that counts for, in essence, that's best practices, that's ways of safeguarding clients' funds, which is really important. In essence, that's making sure that clients' funds are held in a segregated account from that of clients, from the business's funds. With regards to the specific question on the audience, remember they're around regulations around specific spreads or costs from the market. There isn't any regulations on that point. So a client's always got to be really conscious and shop around, make sure they're dealing with the right people.
So how would a reputable FX company take its rates? Does it do a sort of daily scan of all the different rates and come up with some kind of compromise, or how does it work? I'm not very financially orientated, I have to tell you. So.
Well, from different providers that are out there, old school, a lot of people would traditionally go to the bank, and way back when the banks would set the exchange rate at the beginning of the day and take a spread off that central level to ensure that if a client walked in at 4 o'clock in the afternoon, that they weren't doing it at a loss. That's one of the advantages of dealing with a specialist firm, because they'll buy live in the market, allowing us to get a lot closer to the central level and ultimately provide that client a benefit, a saving. Bottom line, if we couldn't provide that client a value or a saving, the industry wouldn't be there. So I'd always encourage people to engage with that specialist firm and make sure that they're getting the best service.
Okay, sounds good. I mean, just on a sort of market commentary point of view, have you found an increase or a decline in overseas business when it comes to property-related purchases?
Generally speaking, everyone's still desiring that place in the sun. The majority of clients are still aspiring for that dream to have a place in the sunshine. Obviously, we've got it here in the UK at the moment, enjoying great heat wave, but people are still keen to buy abroad, yes. So from a private client's perspective, we're seeing a lot more people looking at exploring that option as they've got to that stage in life.
Yes, I know you have some sort of particularly strong ties in France. Is that market holding up well?
It is, yeah, correct. Yeah, so we've got 7 offices across Europe. So we actually also cover Spain, Portugal and France, which are the main demographics from the UK market perspective, and all of which are seeing growth at the moment for sure, absolutely.
I see. Okay, good. Thank you for that, Steve. Saul, anything to add to that?
No, I mean, backing that up, I would just say always find a regulated company. Obviously, people will come to me, and people like me looking for the FX and looking to change money depending where they're coming from. And all we can do is recommend a regulated company and, as you say, shop around a bit.
Okay. And in terms of the market here, I mean, you're at the coalface, aren't you, by providing the mortgages and advising on the mortgages. So have you seen, since this catastrophe of cost of living shooting up over the last few weeks or couple of months, have you seen any decline in applications? Or
No, actually no. I think there are a number of reasons for that. These things often have a delay. If you're looking at people that are applying now, they've been preparing for 6 months, a year, 3 months, so they're well into the process. So macroeconomic things changing quite suddenly probably wouldn't affect their decision making. So these things definitely have a time lag. Also, what you'll see with both house prices and completions, they're obviously a function of things that happened 3 months ago or 6 months ago. Yeah. So with those statistics, you won't see them. I suspect as we come to later in the year and it bites even harder and we get a a winter, hopefully not too cold a winter with the fuel prices, then I think, and I suspect you'll see declining applications, declining purchases.
Okay, and interest rates just continuing upwards, I presume?
Unfortunately so, it looks that way. Bank of England base rate continuing to go up. I suspect that mortgage rates are starting to top out now, and even with small Bank of England base rate rises, interest rates for mortgages won't go too much higher. They made a very adverse reaction in the last couple of rises, and the banks really increased rates. And I think they did that because they suspected further interest rate rises. So hopefully it's been built in. And hopefully we see some stability in that market.
And where are we as if there is such a thing as an average interest rate for a mortgage at the moment?
Okay, so it's a very interesting topic that. When I first started in the industry 20 years ago, the average interest rate was over 8% for over the last 25 years. So if you took every interest rate, it averaged about 8%. Obviously, that has dropped dramatically, and then we've got a lot of people at the moment who are used to 1%, 1.5%. I always say to people, my first mortgage was at 5.99% 2-year fixed, and that I felt was pretty good value. So the fact we're at 3% now does feel harsh to the people that expect 1.5%. But in the big scheme of an economic cycle, I actually still think it's very reasonable price.
I think money's still cheap.
Yeah, effectively, money's cheap at 3%. Absolutely.
Okay, great. Thank you both very much indeed. That's all we've got time for in this half of the show. So join me again after the break. Hello and welcome back to part 2 of Property Question Time. I'm Stephen Galpin, and with me is Saul Conway and Steve Eakins. Welcome back, guys. Saul, your first question of the second half. I'm about to reserve my first property purchase. However, with regards to mortgage options that might be available, can the panel advise on whether I should approach lenders directly or go through a broker? It seems brokers charge a fee. However, lenders themselves don't seem to. Have I got that right?
Well, in essence, yes. Most brokers today will charge a fee. And there's reasons for that I'll explain in a second. But you can still find a fees-free brokerage out there if that's what you wanted to do, and there'd be reasons, pros and cons for doing so. With regard to going to the lender direct, if it's your own bank and they have details about you already, there may be an advantage to it. But what you then need to be assured of, not only is your bank offering decent rates, competitive rates at the time, but you're also eligible. And banks can be a little bit more difficult with regard to eligibility, irrelevant if you are with them or not. So that's probably one of the main reasons that well over 3/4 of the market these days choose to use a brokerage for their purchases. You get a wide range of choice, and most importantly, that brokerage, that advisor, will look at all of the various options and make sure you're eligible to get the mortgage through. And at the end of the day, the most important thing is the property purchase. You just want to get it done, especially in a competitive market. And in order to get it done, you want a surety over that mortgage going through, even if it's not the very lowest rate on the market. The most likely is that your broker will find you the lowest rates as well. So yes, your bank could be a simple route if you happen to be lucky that they have lots of details about you and they're offering great rates at the time. But if you want to be sure and you want the best service, you tend to pay the fee, and that's why the fee is there, to increase service levels and get choice and get advice.
Okay, so when you're saying about choice, I presume you're talking about choice of product.
It's not just product, it's provider as well, but yeah, absolutely. At any one time, there's 3,000 products on the market. If you walk into your bank or even try go down the high street and walk into each lender, you're going to maybe see 50 of those products, 100 of those products. As I said, you may be lucky, and within those 100, the right product for you is there. But if you want to make sure that you've assessed all 3,000 products on the market, you need someone to be doing that for you.
Okay. And I mean, I going back a number of years, hundreds of years ago, when I first started having mortgages and things, there was a great sense of worthwhile as to being loyal to your particular bank and them to you or the lender. I mean, a lot of the building societies converted to banks, didn't they, over time? Does that loyalty still count for anything, or is it simply
I'm going to say, unfortunately, that it does depend on the bank. So there are some providers, some lenders, some building societies who will take that loyalty into account. You've banked with us a long time. We've seen your income coming in and rising over this time. We can take that and use it favourably for you. But there are other banks, one that I actually bank with, where I tried to do a mortgage through them, and they said, we need all of your details again. And I said, well, you've got it all, I bank with you. And they said, well, it's a different department, so you need to send all this through. So yes, there will be some building societies and banks that you have that advantage of loyalty, but it's very few and far between these days.
Gone are the days like when I went to lunch with my bank and I was asking for a mortgage, and we finished the lunch, and I said, so what do I have to do? And she says, well, you've done it. You've just asked me. And I said, yeah, but when do I get an answer? She said, I've told you, yes.
Yes.
and I'll send the forms over this afternoon, all completed.
I think the Financial Conduct Authority might not like that today.
I might not like it today. I don't know if I passed the stress test or not.
And if you take away some of the very top providers of mortgages, who actually lend, the top 3 providers in the country lend about 40% of all mortgages.
Really?
So if you take away from them, banks and providers, lenders, are searching for their place in the market. And the main way they compete, because competing on price is very hard, the main way they compete is the type of client they'll take, the type of lend. Is it a buy-to-let, or is it a shared ownership, or is it someone have a niche? They may have variable income. And so therefore, by using a broker or an advisor, they know these niches and they know where to take the right client with the right income profile to the right bank to get it done. Whereas if you just walk into your bank, they may not fancy a variable income, or the way you earn your income, or the way you bought and sold property in the past. And you won't know that until going through that whole process.
Yeah. I mean, I suppose the difference is that, you know, in times gone by, we've had what I would call specialist lenders, i.e. building societies, who weren't subject to sort of vagrancies of the bank's commercial policies of the day. You know, they were solidly there to lend on property, solidly there to, you know, build community ties, and that really seems to have all gone now, doesn't it?
Yeah, unfortunately, that's had to, due to ever-increasing regulation, and obviously regulation's a good thing, but can go too far, and ever-increasing costs. Building societies, banks have had to find other income streams than just bringing in money and lending it out again. So that has created a very complicated market where they've had to do different things. And these days we do have specialist lenders, but they are more about lending to a portion of the market that the prime banks and the prime lenders don't wish to.
Yeah.
And that might be because you've had bad credit, or as I said, your earning profile is odd, or you want to buy a property that isn't in the norm, might be over a shop, or might be made out of something different that isn't just brick. And then there's lenders that will supply that, and they charge a higher rate, often higher fees, and they're looking for less business, but of a specific type.
Got it. Okay. So Steve, as you're providing financial facilities in one way or another to people looking at buying overseas property, do you get asked about part funding for these projects, or?
Yeah, sometimes. Certainly when there's been an uptick in people looking at new builds across Europe, and they'll see what the funding options that they can get and compare the funding options, taking out capital on their UK asset in comparison to look at funding on their new asset in Europe.
And are we similar?
No, they're not. Different territories are really different and really varied.
Give me some examples. Yeah.
Well, across Europe, for example, you can normally get a lending term which is for the full 25-year contract term. So you're not renegotiating the cost of that debt, that loan, that exposure every couple of years. And you'll equally have different time periods with which you can get easier access to that capital as well. So from Portugal, for example, you can put an offer in on a property and take ownership, take delivery of those keys and pop the bottle of champagne to celebrate within a matter of weeks. Whereas in France, if you're taking a loan on, it could take 3 or 4 months. Right. So there are a few differences for sure.
Okay, good. Okay, thank you, Steve. So we'll now move on to your second question, which is, if I want to forward reserve foreign currency to facilitate the purchase of an overseas second home, to what extent is my money protected if I'm asked to place a substantial deposit with the FX company, which may be held by them for quite some time?
A good question. And this is maybe take a step back to define a forward contract, which is what's being talked about for the audience. When you're securing positions, securing money, you'll normally look at one of two of the main products that we can supply. First is what's technically called a spot contract, which in essence is a buy now, pay now option. So you need to settle in full within the course of a couple of days. The secondary is the forward contract, which in essence is a buy now, pay later option. So the application for this normally is if you are looking at securing a property abroad and you know that you've got that 3-month period, for example, you lock in that cost at the beginning so you know you're not exposed to any change in the market movement and therefore an additional cost at the time later. But it's always that risk against reward ratio as to what the best option might very well be. with regards to the specific question around safeguarding and regulatory elements around that capital. So on a forward contract, they can normally run from a period of a week to a couple of years in theory. And from a private client's perspective, they're normally requested to put down a deposit against that, which is normally somewhere in the region of 10%. So if it's a new build, they can put that 10% down for a period of many, many months. The regulatory in the industry is around safeguarding clients' funds. So those funds are held in a segregated account, not connected to the business running account. Unfortunately, however, the forward contract deposit isn't included in that safeguarding policy. So it's super important that clients look around at all the different providers that are out there and appoint someone who offers all the services and have gone that longevity to make sure they're comfortable with it and getting the best value, which equally isn't always specifically around price. There's a number of other things to consider when you're engaging with a specialist transfer or payments firm.
Okay, so how much, so if I was to come to you and say, look, I'm buying somewhere in France, for instance, in 6 months' time, and I'm fairly happy with the exchange rate today, and I want to know that my calculations will stay the same for that period of time and at the end. So I give you a 10% deposit and that fixes the rate. Would you advise a sort of non-industry person to start making those sort of speculative moves in a way? I suppose it is speculative because what you're doing is saying, well, I think today's the best rate. Or are you or your fellows in the industry, are you there to advise on that, or would you stand back from advising?
We would 100% step back from that. No one has that elusive crystal ball, otherwise we'd all be millionaires and enjoying the beach.
Well,
and
I don't know.
I
look on the internet, all these people that say we can make millions using everybody else's money. And
very different. But yeah, from a currency perspective, no one has that crystal ball. So when you're engaging with specialists, you'll find yourself having very different services with different people. And the ones that are growing are normally the ones that provide all that value. Whereas our prior topic around reaching out to a bank, and a lot of people still go to the bank because they think, the bank's there, I'll go and engage with them. But the engagement from a bank will normally be, here's the rate, take it or leave it. Whereas you speak to a specialist firm, it's around, the days and events coming up that might provide a difference, here the arguments for and against, so a client can make an informed, educated decision in line with their own risk appetite and the availability of capital.
Yes. So just to be very, very clear on that, you'd urge caution from the non-industry professional, would you?
You certainly need to make an informed, educated decision. Make sure you've got that rounded view so you can make that informed decision 100%. And it's balancing that risk against reward ratio, i.e. asking that question, if the rate of exchange goes up a bit, how much does that mean to you? How much would that celebrate? But equally, if you roll the dice on the market and the rate of exchange goes down, how is that going to make you feel? What does your budget look like? Can you absorb that additional cost, or would you have to take on more lending as a consequence? So they're making that informed decision.
Okay. I suppose the other alternative is there any kind of insurance that you can take out against sort of any super fluctuations either way?
The products do exist, but not normally to private individuals. No, you need to be a professional trader to have that access.
And it'd have to be big
and that's
big
more
money,
of corporate firms as well that will explore that over particularly political events or economic events, yes. But from a private individual, that option isn't available.
Okay. Well, there we are. Now, that's all we've got time for on this show. So I'm going to say a big thank you to Steve Eakins and Saul Conway. Thank you both very much for coming in. You've survived your first property question time, so well done, guys. Very good to have your information. Very appreciative of that. Thank you very much indeed. So I'm Stephen Galpin. Join me again next time on Property Question Time.